Hello all, myself Dr. Ibha Rani. Today in this lesson, I'll be discuss about the concept of cost of capital. Today's agenda is cost of capital, components of cost of capital, which includes cost of equity capital, cost of debt capital, cost of preference share capital, and at the last we will calculate weighted average cost of capital with examples. So, before moving to the cost of capital, we'll look into the major financial decisions by a firm. The first decisions taken by a finance manager in a company is the financial decisions. Financial decision talks about from which sources the company will get their funds if any requirement is there. So first one is raising the funds, and after raising the funds, where to invest those funds, how to distribute that returns earned from the investment to their shareholders. So these are the four major decisions are there taken by a finance manager. So when you look into the financing decision, the first major concept under the financial decision is the cost of capital. So we will understand what do we mean by the cost of capital. So cost of capital is the minimum rate of return a company must earn on its investment to satisfy the expectation of its investor and to maintain its market value. So if I'm an investor, I'm investing in the ABC Limited company and I'm expecting the return of 10% from that company, means the cost of capital for that company is 10%. That's why it is the minimum rate of return required by an investor. In simple term, it can be understood as it is the firm's cutoff rate. Company's minimum rate of return it should earn from his investment. That is only talks about the cost of capital. From a management perspective or as a finance manager, cost of capital acts as a benchmark for evaluating capital budgeting decisions. Capital budgeting talks about the way to invest. They have to allocate their capital in different investment options through certain techniques. Those decisions are known as capital budgeting decisions. Cost of capital also helpful for designing an optimal capital structure. Capital structure talks about the combination of or mix of or compositions of different long-term sources. It may be equity, it may be debt funds, it may be preferences, it may be retained earnings. It is also considered as cost of capital is also a basis for measuring the financial performance of a company. So the cost of capital is minimum rate of return required by an investor. That is the cost of capital. Now, different components of cost of capital, or it is also known as types of cost of capital. Cost of debt funds, cost of equity, cost of preference share capital. So now we will understand one by one what are these components and how to calculate these components. So first one talks about the cost of debt funds. It is the cost of a company which incurs when the company is raising the funds through the debt funds or debentures or bonds, which will be including the interest payment and other fees. So the formula to calculate the cost of debt funds, I is the interest rate plus face value minus price of debenture divided by the number of years, and total division will be the average of face value plus the price divided by 2. Now it is here multiplication of 1 minus t. Here when a company is raising the funds through the debt funds or through the debentures or bond or any other debt funds, so it will give you the tax shield effect. It means that whatever the interest is paid on the debt, those interest amount are tax deductible in nature. This impact will lower the company's taxable income. That's why we need to adjust the tax rate when we are calculating the cost of debt. That's why in this formula here it should be multiplied by 1 minus T. T is the tax rate. So now we will be the next component is cost of equity capital. So cost of equity capital is simply the rate of return required by the equity investors. So here KE will be cost of equity capital will be dividend divided by the market price or P0. Dividend is there are two ways it can be calculated. If a company is announcing that I will be paying the dividend 5 rupees, 10 rupees throughout the year, means it will be KE will be D by P0. If in the company is announcing that there will be a growth rate in the dividend, then we will be calculating the cost of capital with D by P0 plus G, which is the growth rate in the dividend. Now coming to the weighted average cost of capital. It is the most common ways to calculate the cost of capital is to use the weighted average cost of capital. This is the formula to calculate the weighted average cost of capital. Formula is E by V, where E is the market value of firm's equity and V is the total value of firm's capital multiplied by the cost of equity capital. So when you will look into the component of the cost of capital, there are four major component companies considering when we are calculating the weighted average cost of capital. It may be equity capital, it may be preference share capital, it may be the debt capital, and it may be the retained earning. So in this formula, I have written all the four major component. It based on the company's capital structure. What are the sources they have utilized? Based on that, the formula will be changing. So here E is the market value of firm's equity. V is the total value of the capital of a company, which includes equity plus debt funds plus preference share plus retained earning. Then it will be plus P by V. P is talking about the preference shares divided by the total value multiplied by the cost of preference share capital plus the debt capital in the company divided by the total value multiplied by the cost of debt capital, and it should be as that interest is tax deductible in nature, so this should be multiplied by 1 minus T plus retained earning divided by the value of the capital multiplied by the cost of retained earning. Now we will understand how to calculate the weighted average cost of capital based on one example. So your question is calculate the weighted average cost of capital of ABC Limited Company based on the following information. The company is having the shares, common shares of 50 lakhs, where the 25,000 shares company is having. Then 12% is preference shares of 15 lakhs, 10% of debentures of 35 lakhs. Here the market price of the company share is 25 rupees per share and company is expected to pay a dividend of rupees 3 per share next year, which is expected to grow at 6% per annum, and we need to assume a tax rate is 40%. In this, you look into this question. Here the value they have given, equity funds is 50, preference share is 15 lakhs and debenture is 35 lakhs. But in this ABC Limited Company, the capital structure consists of only three components, which is common shares, preference shares, and debentures. Here, retained earnings have not been considered as source of fund. Now, preference shares, what is 12%? 12% means the company has to pay minimum dividend percentage is 12%. So the cost of preference share will be 12%. Now debenture is 10% debenture. It means that the cost of debt funds before tax is 10% and the amount is 35 lakhs. Only here in these questions, they have not given the cost of equity capital. Instead of giving directly the cost of equity capital, they have given the market price, they have given the dividend amount, and how the dividend will grow, that also they have given you. Based on this information, first we will calculate the cost of equity capital. So previously I have discussed cost of equity capital can be calculated as dividend divided by the market price plus the growth rate, if any growth rate is there, plus G bill value will be there. So here in this dividend they have given is 3 rupees, market price of the shares is 25, and the growth rate will be 6%. So it has been 6 by 100, which will give you 0.06. Now cost of equity we will calculate is 3 by 25 plus 0.06. So this will give you 0.18. Always the cost of, when we are calculating the cost of equity capital or debt capital, it should be calculated in terms of percentage. That's why I have multiplied here with 100 so that it will give you the cost of equity capital in percentage, which is 18%. So cost of equity capital we have calculated. Cost of preference shares, it has been given in the questions, which is 12%, and cost of debt, which is 10%. The interest what you are paying to your debenture holders is 10%, which is before tax cost. So the formula we will apply E by V multiplied by KE plus preference share by value multiplied by the cost of preference share capital plus debt funds divided by the value of the firm multiplied by cost of debt funds multiplied by 1 minus tax rate. So now first we will calculate the total value of firm's capital, which will be including the equity funds, preference shares and debt funds. So 50 lakhs plus 15 lakhs plus 35 lakhs, which will give you total 1 lakh here total value. So value of the firms we have calculated. We will put it in this value. WACC is 50 divided by total value is 100 lakhs or 1 crore. So 50 lakhs by 1 crore multiplied by 18% cost of equity capital we have calculated plus preference share is 15 lakhs, total value is 1 lakh, and cost of preference share is 12%. So that has been multiplied here. Plus debt funds is 10 lakhs and total firm's capital is, total values of firm's capital is 1 lakh multiplied by 12, and tax is 40%. That's why here 1 minus 40 by 100 means 0.4. So if you will calculate, WACC will be coming 12.9%. There are other ways. Tabular method is also there to calculate the weighted average cost of capital. It may be formula method, or you can directly look into this format. You can calculate the cost of capital. But here in previously we have calculated the before tax cost, they have given 10%. But look into this format, sources of capital. First it is there, the amount, whatever is there. Then we will calculate the weighted or percentage or proportion of components of cost of capital. Then here in this column is after tax cost. So here cost of debt, what 10% have been given in the questions, which is before tax cost. So what we can do, if we are using this tabular method, we have to calculate the after tax cost of debt, which should be KD multiplied by 1 minus T. So 10% is the interest you are paying to your debenture holders is 10%. So 10 into 1 minus 0.4. So 6% we have calculated it. Already the same formula method we will use to calculate the cost of equity capital, which is 18%. So directly you can use this tabular form to calculate this weighted average cost of capital. So it is 50 lakhs, 15 lakhs, 35 lakhs. We have added total is 1 CR. Then we will calculate the weightage, means 50 lakhs divided by 1 CR here. 0.5, 15 lakhs divided by 1 lakh is 0.15, and 35